Good afternoon, everybody. Welcome back to the Opportunistic Trader. We are joined by Dave Floyd of Aspen Trading. Dave's been joining us regularly to take us through some technical analysis across all asset classes. You know, he really looks at FX, but his technical studies can really go across all the different markets he looks at, and so it's really interesting, especially with all this volatility. So, Dave, how's it going today?
I'm doing really well, Mike. Yourself?
Very good, very good. A lot of volatility of late in all asset classes. Just last week, we were trading down in the 2600 level. I'm sorry, about like 7 trading days ago. And then we traded up to 2814. And then here we are yesterday. We closed at 2817. Fixed incomes had a big move. Everybody's talking about the yield between the 2 years and the 10 years, the 30 year. And then obviously oil's been all over the place. Dollar as well has started to move, I guess, against a select few currencies. So there's a lot to talk about in each asset class. I guess, is there anything that catches your eye at the moment that you've been paying close attention to on technical?
Well, I mean, as you just said, there's a whole host of things to talk about because there's asset classes are going everywhere. For me and for people like myself who've been in this business for a long time, this is a gift. Getting lots and lots of movement in the underlying asset classes, and that creates opportunities. And for some people, it's a nightmare. They're not used to this type of environment, and this is not normally how it is. Although this is more volatile than we've seen in the let's say the last 5 to 10 years. But this is what creates opportunities for traders, and this is what drives the buy and hold crowd absolutely insane. So if you're trading in here, it's fantastic. The last couple of months have provided really good returns. You just have to be nimble. And I think what's really important in this market is that even if you have a lot of conviction on a particular trade and you're really trying to milk it, let's say, for what you expected from that trade, I think it's really important that you temper those expectations as new scenarios unfold in front of you. Literally, hour to hour, things can change and expectations need to change with that. I've seen a lot of people over the years, myself included, you latch onto a big move in the S&Ps or 10-year notes or the dollar, whatever it may be in a market environment like this. And you're really thinking you're going to nail that home run. And the next thing you know, you're back to break even or underwater. So this really does require you to be content with the gains you get because sometimes that volatility can take them away quickly. So you do need to be nimble. And what I would say is probably non-attached to your positions. This is not the type of environment where you do your valuation analysis and your technical analysis on a stock and say, well, this stock's worth X and I'm going to hang in there. Market doesn't really give a shit about that. It usually doesn't, but it definitely does not care about it in this type of a market environment. So lots of opportunities, but you need to be nimble and need to be very pragmatic. And I think what I'll do today, pretty much like I normally do, is just kind of cover the broad asset classes. And I think what I'm seeing in the S&Ps right now can either be seen as, well, there's always multiple scenarios, but the two dominant scenarios that I see, and I'm going to pull this out to, I think, a 6-hour chart will probably adequately, maybe a bit of a daily, just to give the complete context. Obviously, we had this big break lower in February, and I think that was the start of this market environment going back to what I would consider a more normal environment. Not this grind up every day where everybody's a genius, but more into a market environment where you really got to be thinking and be nimble on your toes. But the key thing that I'm trying to tackle right now, and again, I don't know the exact answer, and that's okay. We can't always know. We can only create scenarios and see how they unfold. What I'm trying to determine right now is, are we in the midst of a new leg lower in the S&Ps, which would complete a larger degree correction? That is certainly possible. That would take us down to around 2,500. But I started looking at the charts yesterday. I'm thinking, it's entirely possible this move that began back in late October might just end up being a sideways chop fest in this wave B. I have wave B actually right now going as A, B, and C up. But again, it could just be a sideways chop fest before we have one more leg lower. If that's the case, that's going to drive people insane because you're going to get these big rips up, and then you're going to get these big rips down, and there'll be very little follow through. And again, that's the nature of a sideways, choppy, or what Elliott wave guys or gals like myself would call a triangle. I'm not going to sit here today and say that I think it's going to be a triangle or I think it's going to be a leg lower. I think both of those scenarios are equally probable. So I know it might be a little bit messy on the chart here. Let me maybe take it down to a 6-hour chart and just give you a sense. Let me get rid of these wave labels just for ease of illustration in here. So what I'm actually thinking is that, I'll get rid of these too. I have a funny feeling given the way the market dynamics are right now, where certainly someone with a bullish view could make some arguments. And that bullish view that I see right now is mainly from the perspective of the Fed's kind of tipped their hand a little bit, saying, maybe we can be a little dovish in here. Maybe we should pause. And the one thing I've learned in the last 20 years in this business is that the Fed is always riding to the rescue so nobody gets a financial skinned knee. And while I disagree with that premise, the fact of the matter is the market responds very favorably to that. Everybody always responds to not getting in trouble and getting their hands slapped. So I don't want to rule out the possibility that the market could rally, but I think in the scenario in right now, going sideways with a lot of back and forth seems like a very distinct possibility to me. So if that's the case, and we are in fact in a B wave triangle, this is what we're going to get. We're going to get something like this. And this is what I love about Motive Wave software. It just makes my job of labeling charts a lot easier. So again, I'm not saying this is what will happen, but I do think this is a very probable scenario.
Hey
So we
Dave,
have
so that was an exact question I actually had written down before. How are you coming up with these A, B, C? Like, for instance, I saw you just click something and then they just appeared. But like, even getting back to that daily chart you had, conveniently, a lot of these A, B, Cs are on the exact high and low. Like, for instance, you take a look at that A, you look at that B, and you look at that second A in blue. They're at the high and low. When are those plotted? Are those plotted as it's happening, before it happens, a few days after, a few weeks after? Like, how do you determine that that's the low that you're going to plot as the A or the B?
Yeah, no, it's a great question. It's oftentimes the answer is a combination of all of everything that you just said. I do know that back in February when we had this spike lower, this to me was pretty obvious that there was a top of some degree. One could argue that that might have been the top. That's not the way I saw it. Therefore, with the correction lower, you again after an impulsive move higher, you always have a correction to some degree. So labeling this low as whether it be A or 1, that's pretty much a given within the Elliott wave context. I had to happen to have it labeled as an A. Now, knowing where B was going to
Right.
terminate, that's unknowable at the time. I mean, there are certain situations that normally occur in terms of a wave B. Like, for instance, you normally would think a wave B would retrace about 61% of wave A.
Mm-hmm.
In this case, it actually shot up to about 78. Again, not out of the realm of possibility, but historically speaking, a B wave will usually terminate at about the 61%, which is right about here. It overshot it, came back down, and then down. And then when we started to move lower, I can't recall specifically, but I know for a fact that I was probably thinking, okay, B's in, we're going lower in C. And then when we started to rally up again, we're like, that didn't happen. But the one thing I did know as we continued to roll into late 2018 is that this series of moves, especially up and through here, is not impulsive. Now, that did only one thing for me. That told me that this move seemed to be on borrowed time, but it didn't tell me when. And that's okay. But at least if I know one component, that I'm just not sitting there completely oblivious to the warning signs that are flashing, it keeps me out of trouble. It prevents me from getting caught here. It prevents me from getting caught here. But what it did prevent me from here is being long. I couldn't really be long. I could be tactically long, in and out. But it was really hard for me to kind of latch on and say, yeah, we're going to go to new highs here. And we did go to new highs, but that was short lived. So I think your question's fantastic. Sometimes you can make a very concrete decision as to where to put that label. Other times you are basically speculating or using historical, patterns and historical data to say, well, normally if this happens, this is what should follow. And then of course you wait for things to unfold, and they either unfold in the way you thought they were or you make adjustments accordingly. And again, I don't think Elliott wave is any different than any other style of market analysis. Everybody goes into a trade with a game plan, or at least most people do. And when that game plan doesn't get validated, they pivot and make an alternative game plan. Elliott wave is no different, but sometimes people pick on Elliott wave as being too subjective and everything. But then when we get into here, which I think is probably more relevant because this already happened. Right. Now this is where I think this is where the rubber meets the road. What do you do with this? I mean, this is not easy for anybody, and it's definitely not easy for those that are in the buy and hold camp. And again, I'm not picking on RIAs in the traditional sense, but I see them around town here. I know a lot of the guys and gals that are RIAs. I don't maybe know them personally, but I know of them. And I can tell by their demeanor now, they don't know what the hell's just hit them in the last couple of months. They have no clue what is happening here. They've gone from being smug, I'm a genius, and I index everybody, and I'm a genius, to I don't know what the fuck I'm doing. And it's because of this. And most people don't know what to do with this. And I'm not saying I know exactly what to do with this, but at least I can put the market into context to say, I got to be really nimble in here. And the way I look at this is that it's very possible we can just move sideways, back and forth, all the way into the end of the year. And then, again, if you just think about it logically, the start of the new year, even though nothing's changed in terms of, time goes on, the clock strikes midnight, we go to a new day, it does create a new mindset. January 1st rolls around, the mindsets get changed. Guys and gals go back to work on the institutional side and figure out their game plan. So I think it would be very possible we could go sideways into the end of the year and then resolve itself lower, because the way I have it labeled here, if this does unfold as a triangle in the B wave, the next leg has to be lower. And that would take us down to around 2,500, 2,480. The other option is that B wave was completed. We'll get rid of the triangle here. It's possible that the B wave was completed here and then we're going down in C, although I don't see that because this rally here is a little too deep, but it's possible. And if that's the case, then we kind of sell off into the end of the year, and then maybe we come back and dust ourselves off and the Fed's more accommodative, and then perhaps we rip to new highs.
I thought of you Sunday night based on this price action in the S&P, because it's not a perfect triple top, but we got pretty close, given this recent volatility over the past 2 months. We've traded down in the 2,600 range, back up to 2,800, back down, back up. And, on Sunday night, we traded up to 2,814. Now we've traded lower. I guess my question is, how does that look, not necessarily on Elliott wave, but on just a technical pattern with the triple sort of topping formation?
Yeah, exactly. I mean, it very well could be. I mean, from a topping perspective, there might be, again, and I'm not the be all and end all on classic technical analysis. Someone like Peter Brandt is probably the authority on that. But triple top would be kind of hard, only because we have a high over here. If this is occurring at V highs, then I think that's more, more of interest, given the fact that we're kind of in this quote unquote triple top that you're suggesting. Again, leads back to my scenario, is that this is some sort of a triangle within a correction. And therefore, once it resolves itself, we begin to move lower. How does this help, people who are listening to me today? Well, again, I'm not trying to predict these tops. I can assure you of that. That's a tough gig, and that's not the way I approach the market. What I do try to do is, when these levels are hit, which might possibly be a top, I'm looking for opportunities to participate on the move lower or on the move higher. So this has always been the way I approach markets. I usually let the market try to tip its hat as to where I think it might be going, and then I'll latch my wagon accordingly. as opposed to me trying to tell the market where I think it's going to top out or bottom out. Sometimes you catch a break, and you do call the bottom or the top. But as Bill Fleckenstein says, if he's looking to short things, he goes, he wants to shoot him in the back. You go first, and I'll join you after. And I think that's perfectly okay. We're not in the fortune telling business here. We're in the risk management business, and we're trying to identify higher probability entries and exits. So what does that mean for me right now? Well, what I would say, if my give you guys something tangible to latch onto, if my forecast for a triangle is going to play out, the D wave of a triangle, this goes back to LA wave, is typically 61% the length. Let me get rid of this. Should they label? 61% the length of wave B. That's just the normal relationship of what happens. Therefore, yesterday's low might have been the completion of the D wave, which would mean we have got one more little move higher in E, and the E wave will typically be 61% of, oops, of the C wave. And again, if in fact we did bottom out here and we start to get some impulsive action on it, it's certainly possible. We got an oversold stochastic, we've got a composite RSI that's turning up. Then it's possible we make a run back to 2769. So we get another 50 points or so in the S&Ps. And then if that's the case, and we do start to stall out in here, then you got to start looking for that next big thrust lower. But that would take us into the end of the year, at least from a time perspective. I know that's not terribly well, okay, Dave, I don't really know still what to do with that. All I can really do, and all anybody can really do in this market, is come up with scenarios and likely levels that are going to play. So what I've just laid out right there is one possible scenario, that 2695 looks as though we might have, bottomed out yesterday. But again, we're not expecting a big move higher, so you have to temper your expectations. So that's how I'm approaching the market in here. But when you do identify these levels and they do start to take off, they run enough where you can get in and grab that meat in the middle. You're not going to grab the top, you're not going to grab the bottom, you're not going to get the whole move. But if I were, let's say, to drop this down to an hourly chart, and we started to get some impulsive action off of here and then pulled back in a corrective manner, I'd be very tempted to be a buyer, and that still gives me plenty of room to work to the upside. So hopefully that makes sense. Again, I can't serve anything up to anybody on a silver platter, but I can put scenarios out there and then I can act accordingly.
Interesting. What about, let's go to fixed income if you could. What are your thoughts on that move?
Well, I actually shorted a little bit of 10-year notes yesterday, and it's really more of a trade. It's not rooted in, not rooted in looking at all of the various things that are happening right now in terms of the inverted yield curve and all that type of stuff. Although that's certainly, very, very, it's on my radar screen. This chart right here is big time on my radar screen. This is the 210 spread, and it continues to narrow in a very, very aggressive manner. And that tells me that, something's cooking in the fixed income market. And that's usually indicative of a slowing economy, although stock prices may not reflect that immediately, but typically an inverted yield curve, or, contracting yield spread between the 2 and the 10 is not typically what you want to see if you're bullish on equity prices overall. But that particular chart is not necessarily what's driving my 10-year note trade. I will share one other chart with you before I go back to 10-year notes. And this is the spread between G7 and the Barclays 10-year notes, Barclay corporate bond index, and that spread continues to widen. So basically, it's triple B versus triple A. That spread continues to widen. That is not something you want to see as well. So again, that's more like background, kind of what's happening, bigger picture, and that does kind of impact the way I look at charts. And I think that's something that maybe people have not heard before, but I typically try to do my technical analysis based on what's happening overall in the big picture, as opposed to me trying to impose a scenario on the charts. So if we're getting an inverted yield curve, that typically means uh, the potential for weaker equity prices. Therefore, I'm looking at wave counts that are bearish, not bullish. I'm trying to stay with what the theme of the market is. But that's a whole different conversation. But as it relates to 10-year notes, again, I'm thinking, this is not where I'm long from. These are just markers that I use and I drop them in when I need to. I'm thinking that this is just a correction off of the recent lows. And given the fact that this is only in three waves, this to me suggests that we may have topped out from a trading perspective on 10-year notes. So I shorted them yesterday up around 120 spot 05, I think is where I'm short from. Yeah, 120 spot 05. And, I'll probably give it a little bit of room above this high right here. So I'm keeping a pretty tight stop, less than five or six ticks. But if we can get back below this level right here, this A wave high, which is 119.06, that creates overlap, and that gives me the conviction that we've in fact just had an ABC correction off the lows, and then we'll probably take out this low right here at 117.13 or 117.14 and move lower. So for me, it's just kind of a trade. I think we ran up there pretty quick with the S&Ps, and I think we could back off. The other thing I'm looking at here too, and I think it was more evident on the daily chart, yeah, you're just seeing a little bit of a momentum divergence on the composite, making a new high here. The composite index is not. You can see the same thing on the 6-hour chart, making a new high, not making a new high here. In fact, we've basically kind of drifted lower in terms of the momentum divergence as prices have moved higher. Again, that is not like the be all end all indicator, but when you factor it in with all the other things I look at, it's something that gives me a degree of, it checks some of the boxes for me. So I think that's a reasonable trade, 5-7 ticks stop loss, and, perhaps 31 ticks, maybe even more to the downside.
Yeah. Oh, it's definitely been a big mover, and it's going to be interesting to keep an eye on because I think it has a lot of ramifications for the other markets. So I think a lot of the market is taking a close eye at the fixed income market right now. What about in the dollar and FX? What do you find interesting there? I know the pound's been moving around. Aussie's been moving around. Aussie and CAD, especially with all the trade talk and how related to the commodity world they are. What are you finding interesting right now?
Well, for me right now, the FX market's been the best in the last couple of weeks. It's been, relative to let's say the S&P and equity markets. I'm having more opportunities there, which is really, really nice to see, because FX markets for a while now, and when I say a while, I'm talking like months, just haven't been as volatile or as robust, but that is not the case lately. They've been fantastic. And I think my overall premise right now is that the dollar's topped out. I think the dollar's going to move lower. We have been long the euro. I'm sorry, not the euro. We've been long the Aussie dollar, Kiwi dollar over the last week. We've trimmed those positions. We're looking to reload them. And we've also been long Aussie CAD, but although we've closed that out. And looking to possibly be short dollar yen, and we're also short dollar Chinese yuan. We've been short that since 692, traded last at 686, although we did get down to about 682 last night. This is the trade for me that took a while to develop. I've been short this one for probably close to a month. It's short around 692, thought we had it, and then we've just rallied back up and chopped, and now we're finally breaking lower. But I think we've topped out on dollar yuan. I think we go lower. I'm short from 692, expecting a fairly bigger move in the weeks ahead to the downside. But for me, I do think that the dollar index is topped out. It's really trying to hold in here really, really well. This is not I will admit, this is not exactly encouraging price action to the downside, which is how I have it labeled. But that doesn't mean...
Looks like a bit of a coil, as a matter of fact, like maybe a flagging coil sort of thing.
Yeah, so again, if the dollar spikes higher, it's not going to be a surprise to me because price action is suggesting otherwise. I just happen to believe that the way the way price action's been moving overall and what I have labeled in terms of the Elliott wave count, and then also the narrowing of the spreads between Europe and the US, that to me indicates, at least historically speaking, a softening dollar. That doesn't mean that we can't go a little bit higher, but that's my scenario right now, and I'm going to stick with that. But I agree with you. I mean, this was very encouraging. This was very encouraging. But then when we came back above, this move right here is where you're like, huh, maybe this isn't the top yet. So like I said, we've been long the Aussie and Kiwi dollar in through this move lower, and now we're looking to possibly reestablish those longs. But much of it's going to depend on how this resolves. If we can get back below the lows here, I'll be very inclined to be the buyer of the pullbacks in the Kiwi dollar and the Aussie dollar.
So you
And
like you think best bang for your buck is sticking with Aussie and Kiwi more so than Euro, Yen, or Pound?
Well, yeah, it's a great question. The only reason I'm not going with Euro right now is that if you look at a relative percent return basis since the dollar topped out here in late November, actually, was it back in? Yeah, it was back in late November. If you measure the move lower in the dollar and then you measure the individual moves in the currencies based on that move, basically relative strength performance on a percent change basis, Aussie and Kiwi are outperforming the dollar index by about 40 basis points, whereas the euro is moving in line with the dollar. So I'm not saying the euro won't move lower because if the euro or higher, because if the dollar index moves lower, the euro moves higher by default. That's just a built-in relationship. But what you're getting, at least as of right now, is that as the dollar moves lower, the Aussie and Kiwi are moving higher in terms of a percentage basis than the euro is. So you're getting more bang for the buck, for lack of a better term.
Okay. Yeah. We actually spoke earlier in the week with Adam Collins of Movement Capital, and he takes a look at market seasonality, and he was pointing out that actually typically December is a good month for the euro, not as favorable for the dollar. So that also is something to keep in mind. I don't know if that's because of whether it be inflows or outflows or corporate, but typically euro has had I think up about 1.5% in December. So we'll see if that plays out.
And see that's all the stuff that I think is really helpful because they're just little check boxes that go into the trade decision process. We don't need to know necessarily why, but apparently Adam has noticed that historically speaking, this is what happens. Well, that's all we have. We can only bring what we know to the table. None of us know what will happen. We can only say, well, this is what's happened in the past. Therefore, it's reasonable to expect for it to happen in the future. And it's what the book by Annie Duke talks about in terms of thinking in bets. None of us, and I think a lot of us try to get hung up on trying to know exactly what will happen. We can't. We can only say, well, odds are we'll probably go higher, and you make your bet accordingly. Or odds are we're not going to do that, therefore I'm going to sit on the sidelines. Because unlike a game of chess where you can know every possible outcome if you can think like that, markets don't provide us that. So you can just line up the probabilities as much as you can, and then you basically have to take the leap of faith.
Yeah, absolutely. All right. Well, Dave, I really appreciate it. A lot of great information as always, taking us through the charts, Elliott wave, other technical indicators. That's Dave Floyd of Aspen Trading. I really appreciate it, Dave. We'll speak with you again soon.
All right. Thanks, Mike. Great. Have a great afternoon. We'll talk soon.
Thanks.